Hello everyone. Today my presentation's topic is about deductions. My focus in this presentation is about the two limbs of the general permission. Then I'll specifically talk about fines and legal expenses in terms of deductibility. Last not the least, I'll talk about the capital limitation under the general limitation of deductions. In Income Tax Act 2007, Section DA1, a person is allowed a deduction for an amount of expenditure or loss, including an amount of depreciation loss, to the extent to which the expenditure or loss is incurred in deriving assessable income or excluded income, or a combination of their assessable income and excluded income, or incurred by them in the course of carrying on a business for the purpose of deriving assessable income or excluded income, or a combination of both income. This is what we called the general permission. Furthermore, Section DA2 gives the general limitations. Any expenditure or loss to the extent that it is of capital nature or private nature is prohibited from deducting. Also, a deduction for expenditures or losses incurred in deriving exempt income, non-resident withholding income, non-resident foreign-sourced income, or income from employment is forbidden. It has also been ruled that each of the general limitation in Section DA2 overrides the general permission. The first part of the general permission is referred as the first limb. It is about identifying the nexus between the expenditure or loss and the derived income. For an expenditure or loss to be deductible under the first limb, there must be sufficient evidence to support a close relationship between the expenditure and the income-generating activity. We have to ask the question, did the expense arise as part of or in the course of carrying on that activity? However, a nexus does not merely determine depending on whether the expenditure generates income or not. In the case Commissioner of Inland Revenue versus Banks, the taxpayer was employed part-time as a tutor at a polytechnic. Except for the tutorials themselves, the polytechnic did not provide any office accommodation for the taxpayer. The only room in his house that he could use to prepare lectures and mark papers was the dining room. He used the dining room solely and regularly for that purpose for 6 to 8 hours per week for 35 weeks of the year. The Court of Appeal held that the expenses in relation to depreciation, interest, repairs, rates, insurance, heating, and lighting were deductible. At that time, the general permission is ruled as follows. Expenditure or loss incurred in producing of assessable income is deductible to the extent to which it is incurred in gaining or producing the assessable income for any income year, or is necessarily incurred in carrying on a business for the purpose of gaining or producing the assessable income for any income year. But we have to notice that the employment-related expenses are no longer deductible due to the employment limitation in the Section DA2, subsection 4. According to George Richardson, the scope of the income-earning activity and the relevance of expenditure has to be examined, rather than the purpose of the expenditure. Compared with the second limb, the first limb could apply to all taxpayers, including people who do not own a business. For example, if a person rents his house to a tenant, which does not lead to an existence of a business, then the repairs and the maintenance expenditure connected with this house could be deductible under the first limb. However, the second limb is a wider test than the first limb, and relates to the carrying on of a business. In some circumstances, Expenditure which cannot be deductible under the first limb can be deducted under the second limb. Let's say another case. The taxpayer is a newspaper company. The company made a payment to settle a claim for damages arising from a defamatory article published by the paper. The expense does not assist in the income-producing process because, in the year of settlement, the income-earning process of that particular edition of the newspaper is complete. Although the expenditure cannot be deductible under the first limb, it was held deductible under the second limb because the court thought facing common law defamation proceedings was an ordinary inherent risk of the publishing industry. Next, I'll talk about the legal expenses. Under Section DB 62, legal expenses means fees for legal services provided by a person who holds a practicing certificate issued by the New Zealand Law Society or an Australian equivalent. Generally, the deductibility of legal expenses can be determined by the two limbs of the general permission in Section DA1, unless it satisfies one of the general limitations in Section DA2. In the case Nicholas versus the Commissioner of Inland Revenue, the taxpayer was charged with importing goods illegally under the Trade and Industry and Customs Act. The taxpayer claims to deduct legal fees for defending the charges. The High Court concluded that it was commercially necessary and prudent to take advice as to whether a breach of law had occurred and as to the best way to minimize penalties. A sufficient nexus was established between the carrying on of the taxpayer's business and the legal expenses. Therefore, these expenses could be deductible under the second limb. According to Section DB 62, when the total legal expenses for an income year is equal to or less than 10,000, the related legal expenses can be fully deducted without the need to distinguish between revenue and capital. However, if it is more than 10,000, then normal tax rules will apply, and capital and revenue amounts must be separately identified. In order to be deductible under the Section DB 62, the legal expenses must satisfy the general permission, and the other general limitations still apply. The Income Tax Act 2007 also gives some supplements to general permission in terms of deductions for legal expenses. For example, a taxpayer is allowed a deduction for expenditure in determining their tax liability, including costs in challenger assessment. The Income Tax Act 2007 also specifically allows a deduction for legal expenses in respect of borrowing money used as a capital in deriving income, preparing and registering or renewing a list of property, and the grant, maintenance, or extension of a patent. Subject to Section DB 62, non-deductible legal expenses include acquiring and disposing of capital assets, forming, registering, or liquidating a company, increasing, reducing, or alerting the capital structure of an entity. Expenses aimed at alerting or improving the capital structure of an organization in order to obtain a permanent and enduring advantage are not deductible on the grounds that the expenditure is of a capital nature. And the last, legal expenses incurred in the sale of a business. However, the cost of valuing trading stock is deductible. Next, we are going to talk about fines and penalties. According to cases both in New Zealand and overseas, fines and penalties are suggested non-deductible irrespective of whether the statutory nexus is met. Pointed out by the interpreted statement, fines and penalties income tax deductibility issued by the Inland Revenue. The two main reasons were that the payment satisfies the requisite statutory deductibility test and overriding public policy consideration exist. Nicholas Nathan Limited was an importer that imported certain goods in excess of the license held by it. Because of this, proceedings were brought against the company, and it suffered 2 fines and forfeiture of certain of the goods. In the course of the proceedings, the company sought legal advice and incurred significant costs in doing so. It then deducted the amount of the fines, the price of the forfeited goods, and the legal costs incurred from its income for tax purposes. The Commissioner of Inland Revenue refused to accept these deductions. Fines and penalties imposed by the court are, as a matter of public policy, not deductible for tax purposes. The policy of the law denies the right to claim those deductions on the ground that it would frustrate the legislative intent and that the punishment imposed would be seen to be diminished or lightened. The fines imposed on the company were accordingly not deductible. In this case, Judge Sinclair said, no deduction ought to be allowed, for do so would be to prefer business lawbreakers over individuals, as the business lawbreaker would obtain the benefit of deductibility of the amount of the fine or penalty, whereas the individuals would have to bear that particular expense personally. Additionally, it would tend to allow and encourage lawbreaking, and in some instances to even treat it as a legitimate business option, resulting in deductibility. In Section DA2, the most important limitation is the capital limitation. Although a deduction for expenditure or loss of a capital nature is denied, most items of tangible capital expenditure and some of intangible expenditure can be depreciated in accordance with the depreciation regime in Subpart EE. Despite of the importance of capital limitation, there is no definition of the term capital given in the Income Tax Act 2007. However, there are several approaches provided by case law to determine whether expenditure is capital or not, and a 3-step methodology that links the capital revenue boundary for both income and deductions has been developed. The first 2 steps are the traditional criteria and guiding principles. The third step adopts an alternative approach that does not need to apply the traditional tests. Traditionally, when the court determines whether a payment is of capital nature, it will consider whether the revenue is assessable. In case Commissioner of Inland Revenue versus Whitey and Lawrence, Lord Nolan stated that it is familiar law that within the context of the same business, similar principles will apply to payments and to receipts. In the leading case BP Australian Limited versus FCT, 8 criteria have been outlined to help determine whether any outgoing is of a capital nature or not. According to Lord Pearce, the guiding tests include the need or occasion which calls for the expenditure. This test considers what promote or necessitate the taxpayer to incur the expenditure, and whether the surrounding circumstances and ultimate objective of the expenditure indicate a capital or revenue characterization. The second one is whether the expenditure is recurrent in nature. This test, which is closely linked to the one above, said that recurrent expenditure is often of a revenue nature and that one-off expenditure is often of a capital nature. However, this test is not determinative. The third one is, does the expenditure create an identifiable asset? Under this test, expenditure will be of a capital nature if an identifiable capital asset was acquired by the expenditure. Accordingly, legal fees incurred in acquiring legal property will be capital expenditure. The fourth one, does the expenditure create an asset or advantage which is of enduring benefit to the business? While this test is similar to the identifiable asset test, it focuses on whether an enduring asset or advantage, whether tangible or intangible, was acquired by expending the money. If it was, then the expenditure is likely to be of a capital nature. The fifth one is whether the expenditure is on the taxpayer's business structure or on the income earning processes. This test aims to distinguish between expenditure which relates to the structure of the business and expenditure that relates to the operation of the business. For some business, the structure may consist mainly of intangible assets. This test is often linked to the identifiable asset and enduring advantage tests. The sixth one, whether the source of the payment is from fixed or circulating capital. Under this test, expenditure made from fixed capital is more likely to be of a capital nature, and expenditure made from circulating capital is more likely to be of a revenue nature. However, the courts do not give this test as much weight as they used to, as it is easy for a business to choose whether to finance an asset, say from fixed capital, or to finance it from circulating capital, irrespective of the nature of the asset financed. The seventh one, the treatment of the expenditure according to the ordinary principle of commercial accounting. And the last one, whether the expenditure was ordinary expenditure in the course of the regular income earning conduct of the business. Many of these principles overlap, and some of factors will carry more weight in given circumstances. In certain cases, one or more factors may very clearly point to one particular conclusion, such that no further inquiry is necessary. In other cases, some tests may point to a finding of capital, while others a revenue. Accordingly, while these principles are helpful as a starting point, in every situation, it is nevertheless necessary to analyze these factors as a whole and weigh up which factor carry the most weight in light of these facts. It should be emphasized that these principles cannot be applied rigidly, and ultimately, each case must be decided on its own merits. These tests only provide guidance. The guide principles have been applied in many cases. For example, in case Fuller Bay of Ireland Limited versus CIR, the taxpayer tendered for the Auckland to Devonport ferry service contract when it came up for renewal for a 5-year term. The ferry service had been operated by another company with the benefit of a substantial subsidiary from the Auckland Regional Council. The taxpayer tender was initially accepted by the ARC, but ultimately proved to be unsuccessful, and the contract was re-awarded to the original contractor. The taxpayer issued proceedings for breach of contract against both parties, claiming substantial damages. The taxpayer sought to offset the legal fees incurred in connecting with those proceedings against its liability for income tax. The court applied the guide principle in the BP case and then came to the conclusion that the expenditure of legal fees incurred in attempting to secure a contract for the provision of a ferry service was not allowable deduction of a revenue nature under the Section BD2, subsection 1 of the Income Tax Act 1994. Instead, it was a prohibited deduction of a capital nature under Section BD2, subsection 2 of the Act. The purpose of the expenditure had been to secure the ferry contract as a major addition to the business, and the expenditure had been made once and for all. The expenditure had been made on the structure of the business, which was a capital asset, and a 5-year contract was capable of being an enduring asset. Other tests relating to the source of funds as being from fixed or circulating capital, or the treatment of the expenditure and the accounts, were not significant. What was important was the overall purpose behind the expenditure. Therefore, the expenditure was concluded as of a capital nature and therefore non-deductible. Another approach, called asset characterization approach, has been used in some cases to assist to determine the nature of the transaction. In Harker Bay Power Distribution Limited versus CIR, the HBP company had a firm policy of replacing existing overhead reticulation system with underground cables, primarily for aesthetic reasons. This encompassed installing underground cables in new subdivisions, improvement to standards of supply, replacement of inadequate or deteriorated parts, and to increase load where required. In 1998, approximately 85% of all urban area had been replaced by underground cables, at an entire cost of approximately $45 million. For the income year 1987 to 1991, HBP claimed a deduction of $1.95 million, being 34% of expenditure spent on the project during that period. The commissioner disallowed the deduction. In that case, the courts applied the identifiable asset test, and the court had for the commissioner, because the context of a declared policy to convert the underground cable. The gradual but consistent placing of 85% of all conductors underground at a cost of $45 million created a substantial new urban residential distribution system, and therefore a new asset for taxation purpose. So, based on that reasons, the money expended was capital and could not be deducted. Yeah, that's all my today's presentation, and thanks guys for watching it. And if you have any questions, be free to ask.